In Section 2 of Module 3, we're going to begin by reviewing the definition of demand management, this time within that outsourced manufacturing model. Demand management, as we know, refers to the ongoing process of identifying and planning for all sources of product or service demand. We're focusing on products here, but it can apply to services too. Moving on, and this point is as important in an outsourced model as it is as a manufacturer ourselves, but demand management requires that practitioners weigh demand against production capacity. When we're the manufacturer ourselves, that's relatively easy to do because we know what production capacity we have. In an outsourced situation, we're not going to be 100% sure what the production capacity is of our vendors, of our suppliers overseas. As such, we have to pay special attention to demand management as it relates to the production capacity of our overseas manufacturers. In any scenario, when demand exceeds capacity, demand management prioritizes the allocation of resources. The question for us as a company that doesn't manufacture, we import finished goods for resale. How do we do that with third-party manufacturers over which, at the end of the day, we don't have control? They're the ones that have to prioritize the allocation of their resources. We have to make sure that they're doing that on our behalf and not other customers of theirs. Things really do come down to just that. That's part of managing overseas manufacturers, overseas vendors. Couple of more points on demand management in our outsourced environment. Demand management encompasses a number of functional activities that we as a manufacturer would have to do ourselves. Now we're working collaboratively with our overseas manufacturing. No matter what, it is us as the importer that has to create and share a forecast for products. We can work with outside parties to determine what that forecast is, but at the end of the day, it's on us. Of course, order management, the handling of actual customer orders, that is also on us. And how we compare forecasts for what we thought we were going to sell and actual orders that we get from customers, and how we manage the difference between the two and continue to work with our vendors overseas to make sure that we don't get caught short without enough product or we don't overbuy. More on that in just a little bit. Available to promise is also a part of demand management. What inventory do we have available to promise to our customers based on the inbound orders coming from overseas? And probably most importantly is the interface between the marketplace and manufacturing planning and control activities. Demand management, as it relates specifically to a forecast, is the base upon which manufacturing planning and control is built. The key here is the manufacturing is done by third parties overseas. How do we create a link between what we do, forecasting, accounting for customer orders and such, and how do we share that information on an ongoing basis so our overseas manufacturers can do their own MP&C activities? Super important. Let's move on and review again manufacturing planning and control. It is the process through which high-level strategic and financial planning is linked to downstream functions within an organization. Once again, we'll say, when we are the manufacturer, it is us that has to engage in the activities found in our second bullet point. When we're working with overseas manufacturers, yes, we're sharing forecasts, we're placing purchase orders on those overseas suppliers, but it is the overseas supplier that has to engage in these MP&C activities. That's the divide that we spoke of in Section 1, the decoupling from the buy side of the supply chain to the sell side. This is an illustration of that because it is the overseas supplier, the overseas manufacturer, based on the orders we place on them, that has to engage in production planning, that has to create their own master production schedule, that has to acquire raw materials through material requirements planning, and then plan for the capacity of the plant that they have. How much can they make in a given period? As we've said a number of times already, it is this decoupling that becomes so important to manage for the U.S. importer that's buying finished goods from these vendors, these manufacturers overseas. We've seen this slide before. We will present it again as a supply chain perspective a visual illustration of manufacturing planning and control systems, really meant to illustrate even further this whole concept of the decoupling between the buy side of the supply chain and the sell side. As we've said a number of times, things start, as we know, with demand management. And our period of measurement, our period of operational activity is going to be 1 year. We have to forecast for the products we think we're going to sell for a year. That's a big part of demand management, as we know. The key here is we have to be able to share that information with our overseas suppliers in the form of purchase orders that allows them to start to engage in what? Master production scheduling, MRP activities, accounting for the capacity of their own production lines. This is just another illustration of what we said previously. This whole concept of the decoupling of the buy side of the supply chain from the sell side. Our challenge as supply chain professionals, as an importer, is to bring those functions together as best we can while understanding that we're dealing with third parties in many different countries. That's not an easy thing to do. It is an ongoing function. It's not a matter of doing a forecast and placing purchase orders and hoping everything works out well. That's not how supply chain works. It is an ongoing activity. We will be talking about those activities as we move forward. Let's add a little bit more perspective, albeit a shorter supply chain perspective, on some observations relating to manufacturing planning and control in a global environment. When taken in a global context, MP&C becomes more complex due to factors like distance from vendors and customers, language barriers, time zones, production constraints, product quality issues, systems challenges, and lead time variation. That's a long sentence. Let's break it down a little bit. First off, physical distance. Buying from vendors overseas just isn't the same as buying from a vendor across the street. That should be clear. Of equal importance, how far are our international vendors, the companies that manufacture on our behalf, from our customers? We have customers in the United States. It's likely that we have customers outside the United States as well. From the U.S. perspective, maybe those customers are in California. It's a little easier to get product from Asia to California than it is from Asia to Boston, Massachusetts. That's what we mean there by distance from vendors and customers. Basic stuff, language barriers, misinterpretations of written emails can create really big problems. Time zone differences. We often like to say here in the import community in the United States that it's already tomorrow. In China, for example, a lot can happen in a 12 to 15 hour period. We have to account for time zones. And anyone that's been on a conference call at midnight with Asia knows what that means. Production constraints with the vendors overseas, they're only going to have a certain amount of capacity. And we have to understand that we are not likely their only customers. Where do we fit into that capacity planning? Of course, product quality issues, systems challenges, meaning technological challenges, and lead time variation, which is a topic we've touched on a bit and will continue to elaborate upon. The differences in lead time that can occur from order to order. That's a big deal. If we think about it, the above challenges are even more acute when an importer operates an omni-channel distribution model, as we defined it, and or outsources production to third parties, which of course is what we're talking about in this module. In this type of model, demand signals that come from multiple sources, from stores, from online orders, from catalog purchases, they must be converted into supply signals to those overseas vendors. This conversion of demand to supply signals is one of the biggest supply chain challenges that U.S. importers face in the global marketplace. This is an important slide. We like to think that they're all important, but this one is especially important because it elaborates upon, in writing, what the challenges are inherent to outsourcing manufacturing and operating in an omni-channel model. This is more of a visual illustration of what we just spoke of, omni-channel distribution in that outsourced production model. As we know, and have said probably too many times now, everything starts with a sales forecast for a 1 year period. Then, we as a company hopefully start to see actual demand signals. And if we are indeed running an omni-channel distribution model, those demand signals are going to come from different places. From retail stores, good old-fashioned brick and mortar stores. Maybe we have a catalog that we sell through as well. Orders can come from there. Web sales, needless to say, Depending on our model, maybe we have a U.S. sales force, actual salespeople out in the field selling to businesses. And hopefully we do a little exporting as well. The point here is that these demand signals are coming from different places and are sometimes easier to account for. Moving down and into red, the trick, of course, is how do we convert those demand signals into purchase orders on our vendors? When we have more than one vendor, in this illustration 5, maybe we have 100 in 10 different countries. How do we convert demand signals, be it a forecast or actual sales, into purchase orders on these vendors, and how do we manage that? That's what supply chain is at the end of the day. Some challenges and pitfalls associated with omni-channel demand management. We mentioned this briefly a moment ago, but how easy is it to identify demand signals across channels? Point of sale is probably the easiest way because this refers to when goods are bought in a retail store and scanned, that is a demand signal. The system picks up that sale. Online sales, similar idea. We know about an online sale instantaneously. On the other hand, how about manual catalog orders? There are still companies out there that use hard copy catalogs, mail them out to customers, and those customers actually mail in snail mail orders or call in over the phone, or even still use the fax. As hard as it is to believe that, it's true. Or manual sales orders that are written up by account executives, actual salespeople out in the field, taking orders, as the old terminology used to be, writing up an order and then coming back to the office and getting it into the system. All these different sources of demand signals have to be accounted for, and some are easier to do than others. Another point, how about different products and SKUs for different distribution channels? What we sell online doesn't necessarily have to match up 100% with what our outside salespeople sell. What we sell in a store might be identical to what we sell online, but not necessarily. That's what we mean by different products and SKUs for different channels. And as we see in our sub-bullet point here, one example is different product configuration for exports that have to have special features, capabilities, compliance with government regulations overseas, etc. We can't assume that all products and all SKUs are the same for our multiple distribution channels. Couple of others, different order characteristics by channel. The size of an order versus the value of an order. Think about an online order from an actual consumer. Maybe they buy 5 or 6 things, beauty products for example, that's a $100 order. Whereas a business-to-business order, a salesperson out writing an order, it could be for millions of dollars. With multiple SKUs, physically large orders. The order makeup by channel could be items from multiple product categories. Think about a company that sells online that offers wearing apparel, footwear, and accessories. They're coming from multiple categories, could be coming from different physical locations, could be sourced from different vendors overseas. That order makeup by channel matters on the buy side of the supply chain. And then, finally on this slide, the type of sourcing strategy. Do we as the importer, do we buy in one country from one vendor? Do we buy in multiple countries? That matters as well, because again, it's the linking of the buy side of the supply chain with the sell side. And when we are outsourcing in an omni-channel environment, that is very tricky. Last slide in this section. Again, speaking of the buy side of our supply chain, how about product mixed by vendor? Let's go back to that wearing apparel, footwear, and accessories example. It is not likely that we're buying all 3 types of products from the same vendors. But to a customer, none of that matters because they might want a skirt, a pair of shoes, and a particular accessory, a hat or a pair of gloves. They don't care how many vendors it came from, but it matters to us as the importer because we have to be able to source from multiple vendors and bring them together in single orders, thousands and thousands of times a month. That matters too. Coordination of inbound purchase orders to match product demand patterns. Very important as we coordinate the various vendors, but also the cumulative lead times associated with those vendors. What does that mean? That we get everything we need at the same time when we're dealing with different vendors in different countries with different cumulative lead times. That is reflected actually in our last bullet point here, this idea of conflicting lead times between vendors and the coordination of complementary products. Getting that skirt, that pair of shoes, and that accessory in the same place at the same time. That will wrap up section 2. When we come back and talk about omni-channel demand management, it will continue on with the role of sales forecasts. See you soon.